It's very rare that you invest in a company and 2 or 3 years later you sell the company. So you make an argument which is personal fit. There are entrepreneurs that I met that I had regard for, but I just knew I wouldn't be great partners for them. And so in that sense, I didn't pursue the deals. And those that I thought that I would be a great partner with, I would pursue hard. And I would try to get people to do the references on us and me. And so it wasn't simply about writing a check or the nature of the deal terms. It really was about the interpersonal relationships. And I think sort of stressing that was a way to win a deal. Again, if someone liked you, felt they could trust you during the troubled times, because every company will go through a period of stress, then that was a good way to win a deal. And then ultimately over time, of course, it can be a virtuous cycle. The more good deals you do, the more people that get to know you, the more they like you, the more good deals you get to do. And so if you can get on that virtuous cycle, that could be a winning strategy.
Welcome to the Smart Venture Podcast. We're here to bring you the latest and greatest from the Silicon Valley, where unicorns roam and innovation never sleeps. We've got top investors, superstar founders, and well-known tech executives lined up to share their secrets on building and investing in successful companies. Just a quick disclaimer, while we may sound like financial geniuses, but please don't mistake us for your friendly neighborhood financial advisors. So let's get started and dive into the wild world of tech entrepreneurship. Hi, Terry. Thank you so much for coming on to the podcast.
Delighted that you asked. Thanks for inviting me on.
So can you tell us a little bit more about how you grew up and how did you get into the venture scene?
I grew up in upstate New York, and there wasn't a lot of venture capital. In fact, I've often told people I never knew what venture capital was until I was in my 20s. And of course, this was back in the 70s and 80s. And so I went to school and started looking at startup companies and got exposed to the venture capital process in that way. And thought what a cool job that would be if you can invest in a number of technologies, but probably more importantly, invest in a number of people. And so I was with a startup out of MIT called Management Technologies. They weren't looking for venture capital. And that's how I got exposed to the process and sort of said, I went back to business school, and from there on, I went in the venture capital world. So I've been doing this for now 30 plus years.
Just out of the curiosity, how many people were actually doing startup back then? What was a hot job back in time?
Yeah, there weren't that many people doing startups. It was all hardware, actually. I was in the Boston area, and there was the legacy of the Digital Equipment Corp and some of the early computer players. And so most of the hot jobs were essentially hardware engineers that were looking to get into startups. But there weren't that many startups. There was really a handful of companies, but there was at least a legacy on the 128 sort of corridor that led people to think that there was a possibility of startup companies, and so that's what got people excited.
So can you tell us a little bit background of when you were growing up, what were your hobbies and things that you like to do? And why I ask that is because I feel like a lot of people coming from different backgrounds. So can you tell us a little bit more about how do you do the self-development or self-discovery when you were younger?
Yeah, I had a sort of a blue collar background. My dad worked in a factory. My mother had her own dancing school. And so there was a little bit of entrepreneurship within the family. And as a kid, I was always a sort of a science-oriented kid. So in schools, I enjoyed the math classes and the science classes, and just thought of the possibilities and of discovery. And so when I finally went to college, I then pursued sort of more technical. I did physics, and then I ultimately took an engineering degree, a business degree. And so I think as a kid, though, I was always fascinated by the potential of the world and what could happen. And at the time, it's interesting enough, we're all, of course, waiting for SpaceX to launch in the next week or so. When I was a kid, showing my age, it was really the NASA programs, the early programs, and there was just a lot of excitement about technology and the possibilities. And so I think that's partly what ignited the ideas in some of my head.
So after business school, you started out in the venture scenes. Tell us about what was the first deal that you invested in and how did it go?
The firm that I started with in venture capital was a firm in Chicago called Golder, Tolman, Cressy & Rauner. And they were really transitioning from early stage investors to really later stage growth equity investors. Believe it or not, my very first investment was in a dairy company. There was a consolidation in a dairy, a company called Southern Foods, which was out of Dallas. And I had the great pleasure of working with Bruce Rauner, who was a partner at the time, and sort of helped Bruce with that dairy company, which ended up doing very, very well. But my first technical investment was probably when I came back to another firm called Burr, Egan, Deleage, and I did a series of healthcare investments that I did, and which also worked out pretty well. But my very first was Southern Foods, which was this dairy company.
When you were doing like due diligence back then, how did you source deal? Because back in time, I assume there was no internet going on. So how do you source deal? How do you pick a good investment? Do you read them from the newspaper? Do you read them from basically just connecting with friends? Or how do you connect with other VCs back in time?
It was, again, a very small community. There were probably only maybe a couple hundred venture capital firms at the most. And so, and oftentimes most of the deals were syndicated. So really a lot of the deal sourcing came from working with other venture capitalists. And they would find a deal that they started working on, and they were looking for someone to help them work on the deal. So that was one source. Then the second source, of course, were the entrepreneurs themselves, people who you got to know. And some of my best deals came from entrepreneurs that I had backed who sort of liked me. And so when their friends were looking for venture capital, the entrepreneur would send them my way. And so that was another source. Every once in a while you'd find a technology that was exciting in the newspaper, but usually by the time you read about it, someone else was already on top of it. So it really relied on this network of individuals was the best way to source deals.
Yeah. What was a hot VC firm back then?
The hot VC firm? I mean, Kleiner Perkins has always had a wonderful reputation. They were hot. We thought we were hot.
I'm sure.
I think Wells Carson on the East Coast was always a highly regarded firm. Benrock had always, has a great reputation, had been around for quite some time. So there was some legendary, Greylock as well. So there were some legendary firms that today continue to be legendary firms.
Go back to our topic on investing deals. When there was a really interesting deal coming out, how do you position yourself to be really competitive in getting into the deal?
It's a great question. And I think at least the way I would position it, which is these are very long-term relationships. It's very rare that you invest in a company and 2 or 3 years later you sell the company. So you make an argument which is personal fit. There were entrepreneurs that I met that I had regard for, but I just knew I wouldn't be great partners for them. And so in that sense, I didn't pursue the deals. And those that I thought that I would be a great partner with, I would pursue hard. And I would try to get people to do the references on us and me. And so it wasn't simply about writing a check or the nature of the deal terms. It really was about the interpersonal relationships. And I think sort of stressing that was a way to win a deal. Again, if someone liked you, felt they could trust you during the troubled times, because every company will go through a period of stress, then that was a good way to win a deal. And then ultimately over time, of course, it can be a virtuous cycle. The more good deals you do, the more people that get to know you, the more they like you, the more good deals you get to do. And so if you can get on that virtuous cycle, that could be a winning strategy.
So can you walk us through a deal that you've done in the past and then it went on to be a huge success? How do you encounter this company when the company come to you or you find the company? How did you evaluate it? At what point you decided to make an investment? Did you invest in them right away, or did you sort of like pause a little bit, watch how it grow, and then you invest in them?
I'm going to turn your question slightly on it, which is it's not about a specific deal, but it's about a relationship. And so I'll talk about 2 different relationships. Probably my earliest life science relationship was with Bob Langer, who's a sort of a wonderful national treasure out of MIT. And Bob has started numerous companies. In fact, we at Polaris have invested in over 25 of his companies. And so the very first relationship was I got a call from a friend who was starting a company with Bob. And I got to meet Bob and realize that he was a unique academic. He was a unique entrepreneur because he was so prolific in starting companies. And I remember the conversation, which is many venture capitalists, when they would meet with Bob, would try to sort of say, hey, Bob, why don't you put all your technology into one company? And Bob would sort of say, well, I'm generating new technology every day, and so it doesn't make sense to put them all in one company. And I remember sitting with Bob and sort of saying, I'd love to work with you and do a lot in the future together. And he said, well, that's great. He said that, but I'm not going to put it all in one company. I said, that's not a problem, but just show me every company that you do. And so he said, well, that's easy enough to do, and I'd love to do that. And so I've now been working with Bob for the last 2 decades, almost 3 decades in companies, and there's a number of Langer successful companies. But I think it's really sort of, and so what happens now is Bob will call and sort of say, I've got another startup that's coming out of my lab or someone I've worked with, and he'll call us, and we'll quickly say yes, because we love saying yes to Bob and investing in his companies. Second relationship is the one that I have with Tillman Gerngross up at Dartmouth, and it's a somewhat similar story. Tillman was starting a company in the protein space and called Glycofy. And I got a call from a good friend who was starting with him, and Charles Hutchinson. And Hutch had called and said, "Here's a unique character, which is Tillman Gringos. He's a force of nature." And so we invested in Glycofy. It turned out to be a pretty rapid success. And then Tillman has now started 6 or 7 other companies. And so we've, again, had the same relationship with Tillman as I do with Bob, which is when he calls, the answer is yes. And then the next question is, what are you doing? So it's really, for me at least, it's not about any one company or it's really about these relationships that are maintained, again, over multiple years, if not decades.
I think I watched the talk that you had with Bob at the Koch Institute from MIT YouTube channel. It's really cool that you build these like really strong bonds with someone and eventually you get a lot of really quality deals that way. Curious on your thought, do you invest in every single company this person built? Why I ask that is because in Silicon Valley, I've seen like entrepreneurs that went on create really great companies. And at one point it's not really like every company that they create that's going to be like a continuous success. They definitely have the time that they fall. Do you invest in every idea or do you kind of like pick the one that fits your thesis the most? Another question coming out of this conversation is, I'm curious about like when you were building these relationships with these people, what kind of quality do you look for in them? Are they great scientists or are they great business builders? What kind of quality do you see these people went on to be very successful?
Yeah, the qualities that we look for are and I'll go back to this marriage analogy, which is we're looking for people that we know we can trust, that are basically where we can align our interests as best as we can, and where the goal is, we have a similar goal. In the case of Bob and in the case of Tillman, the goal really is to change the world, to make the world a better place and have a human impact. And so we're looking for people that have that same goal in mind. It isn't simply about a financial transaction or building, just simply building a company. It's about building a company which has meaning. I think some of the entrepreneurs that we backed, Tillman, Bob, Paul Schimmel, Phil Sharp, Harvey Stephenson, they're all unique. They're brilliant. They're highly motivated. They have a unique and an innate business sense, which is many academics don't. And most of the people we back are academics, but these individuals have this unique ability to understand business. And I've often said that, the best entrepreneurs are 95% normal, and then there's something, the 5% extraordinary about them. And each is different. I mean, what's extraordinary about Bob is he's so collaborative and brilliant and creative. And what's unique about Tillman is that he's very decisive and very energetic about getting to a goal. I mean, you can sort of identify each character in some way, and sort of identifying that 5% difference. That's what makes them extraordinary, makes all the difference. But they're all unique, so not one of them copies the other. They all have different styles. But finding those styles has really been the most important thing. Those are the characteristics that we've done for people. We've not done every single deal with Bob as an example. And there's some deals where Bob, we simply wait for Bob to show us deals. Some things he's working on that he doesn't think is right for prime time. Others that he's been invited to and that already had venture capitalist funding. So I can't say that I've done every Langer deal or every Tillman deal, but my goal in life is to do as many as they will show me.
Yeah, that's really interesting to know. In terms of like building these relationships, like eventually you started your own fund. Just curious, like, at what point that you decided to go from like just like starting your own firm? How do you convince your current partners or like your previous partners to join you to creating a fund?
You and I had chatted about this in the past, but I came from a legacy firm, a firm called Burr, Egan, Deleage, and at one point, Burr, Egan, Bill Egan, Craig Burr, and Jean Deleage came to the partner and said, what do we want to do? And we concluded that we wanted to evolve into 3 different firms. And so there was sort of this natural selection of partners. Myself and John Flint and Steve Arnold were the 3 founders of Polaris. We decided we wanted to go off and start our own firm. And the other partners went into 2 different firms themselves. So I think in that sense, it was a natural process. We had a track record. We had worked together. We had looked at deals together. It was a very comfortable, almost fraternal relationship that we were close as brothers, and that we felt that we would be good in both good and bad times. Again, most firms, as you know, go through good periods and bad periods. So it's really knowing that people are going to be well behaved and aligned during the bad periods is the most important thing. And so, we were good partners and we saw things alike. And so when John and Steve and I started Polaris, We had a track record. We could go to limited partners, some of which were the Burr, Egan, Deleage limited partners, and say, this is what the deals that we've done. And at the time, and even today, I think limited partners are interested in sort of new funds. And there was a line that we used that I like, which is, new funds are high on the learning curve, but they're also high on the yearning curve, that they really are very eager to be successful. And so limited partners like that phenomenon of knowing that there's a lot of experience with the firm, but also that there's a team that has something to prove. And so that's what enabled us to, when we had this partnership that worked out well. But we also had limited partners that wanted to back us. And so that allowed us to raise our first fund fairly easily.
Yeah. So basically, when you were creating your own fund, you already had worked with these partners in the past and kind of like already have some track records with them. So when you guys were going on to raise your own fund, how many years of investing experience do you have? And when you were trying to convince limited partners, I don't think that's like a coincidence that you guys can just raise a fund. It definitely means something that you showed that your track record, that's like a really good return. How many companies did you invest in, and what was your return like back then when you just like decided to, or like just to successfully raising a fund?
Yeah, I mean, so without getting into all the details of our track record, I mean, when we went out to raise Polaris, we had cash-on-cash returns that were substantially in the upper decile of returns, and there were multiple companies. It wasn't one single company which generated all the returns, and so a limited partner could look at 20, I'm guessing this now, but we probably had 20 companies between the two of us that we had invested in. And so a limited partner could go back and look and see the profile of the companies that we've invested in. And again, I think that helped with the process. And yeah.
So in terms of like healthcare is like one of the probably the most like long-term investment that a VC could make. It's really hard in terms of how do you do the due diligence in the space, and then how do you kind of like having the strategy works for you. And can you tell us a little bit more about like why do you pick healthcare, and then when you first enter the space, what was your experience like, and then how do you come up with the strategy to invest?
Again, starting investing in sort of the late 80s, early 90s, that's when the biotechnology revolution was really taking shape. You had some early companies like Genentech and Genetics Institute here in Boston, and ultimately Biogen here in Boston that were doing well. And so I think it was the new frontier. And so in that sense, you knew it was going to be an exciting place, and it continues to be an exciting place. So that part of the thesis was right. As you know from my background, I don't have a life science background. I'm more of an engineer, and so I quickly realized that I didn't have the technical expertise to do the evaluations. But I'll go back to my people analogy before, which is if I knew the right people to ask the right questions, I could get good answers. And so that was the other importance of the network. And so, we quickly sort of said it was an important space to be in, that there was going to be a lot of lives that were going to be touched positively, probably good economics that would be attached to doing our jobs right. And then we just pursued it. And so, and like everything else, the more you do, the more you see, the more you see, the more you do. And so we've developed this broad network of successful entrepreneurs and researchers that we've worked with in the past, so we continue to rely on that network. The other thing which we did as the firm grew is we hired in people or brought in partners who had experiences that we didn't have. So for example, one of the managing partners, Emeritus Shad, has a PhD in chemical engineering out of MIT. Brian Chi has an MBA, but also had worked at Baxter and a healthcare company. So we sort of recruited in people that were part of the organization who had skills that we didn't have, and so that complemented what we were doing. But the thesis all along was that healthcare was going to be important, and it, 20 years later, it still proves to be very important.
Yeah, for sure. So for healthcare companies, normally it take a long time to kind of like see the result of the investment. So what were some sort of like the earlier indicators to see if a company went out to be a huge success?
Yeah, it's an important question, and the thing that's been striking to me, having been in the business now for 20 years, is that sometimes the least obvious companies turn out to be the most successful companies. Yeah, there are clearly trends that you're pursuing. For example, in the gene editing space, the whole CRISPR-Cas9 space, and we were an early investor in a company called Editas. And so you could see everything shifting to that was going to be important science. But then there are other companies, and I'll use Glycophi as an example, which is when we invested in Glycophi, which was doing glycosylating proteins using yeast. When I did my diligence, everyone sort of said, don't bother. too many people have tried that before. It's not going to work. You're going to end up losing all your money on it. And we sort of said, well, but if it does work, if we can crack the code, we'll make a difference. And the answer was yes, but no one's ever cracked the code, so don't bother. And so that was a situation where we actually went sort of against the grain and turned out to be a fantastic investment. So I think you have to go back to the fundamentals, which is if the technology can yield, will it have a true impact? And if the answer is yes, then it's probably something that's worth pursuing. But then I want to complement it again with it's the people. If it were just when we did Glycofy with Tillman, it wasn't just any person that was involved. When we did Editas, it was with George Church and some others and Gong and others there. So it really goes back to the people.
Yeah. So I really like the point that you mentioned that you pick the right people and then the right people could pick the right deals technically. So for example, in a space like healthcare, if I go into it as an investor who don't know much about the space, how would you pick the right person? So what kind of characteristic do you have to present to them that they would be willing to work with you? Since they're the expert, why couldn't they just do it themselves?
Often it's described as that academics have a distrust for commercial people because they're afraid they're going to corrupt their science. And so there's often this concern, reticence on the part of the academic entrepreneur to get involved with commercial people and more specifically venture capital. I think the answer is really the past relationships, which is if someone is concerned that we're going to treat them poorly because we're the venture guys, we ask them to call people we've backed in the past to see how we performed. And there's two parts of the answer that they'll get, which is one, Polaris, Terry, McGuire is a good partner to have. But two, as importantly, which is, without the capital that venture capital brings to the equation, your research is never going to see the light of day. It's never going to have an impact. You have to find a commercialization strategy if you're going to truly touch lives, not just have good research papers. And so, but it's a delicate dance and it's a courtship of sorts. And so we work hard at that courtship. And so we try to spend as much time as we can with the academic entrepreneur to tell them why we're excited by the technology and what we think we could bring to the table. And then at the same time, we try to introduce them to people we worked with in the past who will sort of give them some comfort that we're good to work with.
Yeah, for sure. So when it was early on in your career, how do you cultivate these kind of relationship? What would be some actions that you would take? So for example, let's say nowadays, I've always heard about these kind of advice from people that if you want to build a strong relationship with a venture capitalist, you are supposed to send a lot of deals. But on the other hand, I feel like if I'm not confident about what kind of deals am I sending to, are they going to feel like the deal that you selected are not really useful? That's a waste of my time. How would you kind of build these kind of relationship early on when you didn't have much track record?
Yeah, it's a long time ago. I'm trying to remember.
I know. Now you're already super successful. So
I think it's looking at deals, but it's also just getting to know the person. And it's hard to do, by the way, because everyone's so busy these days. You're not going to spend a lot of time there and get to know you. But I think it's as much about that interpersonal dynamic and trust. And demonstrating moments when you had the advantage, but you didn't take advantage, even though you had the advantage.
Right.
And having it go both ways. And I also think researchers are working hard to transform the world. And so finding a mechanism by which they can transform the world makes a difference. And so as far as, you and I have had this conversation, how do you get to know venture capitalists? Well, one of the lovely things about venture capital, one of the challenges is that we're all too busy for our own good, and there's, we're putting multiple balls in the air all the time, and so we're always parallel processing, and so trying to find a way to get to know people to stop and pay attention is hard to do. But I do think it's just a consistency and just being there, knowing what the person's interested in. It doesn't have to be a business plan. It could be an interesting researcher. It could be someone who you think that they would. It could be if they have a passion for golf. It could be a great golfer. It's just some way of sort of saying, hey, Jim, I know you're Ace too. I know you, and I know what you like is this. And here's a great researcher who's working on it, or here's someone who's doing something that you might find cool. And I think just, again, developing this personal relationship, I think makes all the difference.
Yeah, for sure. Yeah, that's a really good piece of advice. I feel like nowadays, everyone wants to achieve a certain level of success really fast, but I definitely feel like taking the time to sort of cultivating the relationship would probably play a long way than just getting something instantly that's rewarding.
Yeah.
Like a lot of what you do at Polaris is like you help people like Bob to kind of like take a scientific research out of the lab to commercialize it. Can you walk us through maybe like one deal that you've done that, like what would be the challenge from taking a scientific research to going into market?
Well, let me go back to some of the earliest ones, because I think they're sort of also telling in some of these questions about relationships. And Bob and I were involved with a gentleman named David Edwards, who was a researcher at Harvard, was at Harvard at the time, although I had been in Bob's lab. And David was doing some really interesting stuff with pulmonary drug delivery. And so at the time, David was, in fact, this is before he was at Harvard, he was at Penn State. And Bob had called me to sort of talk about this opportunity of bringing this technology out. And so I met David. I got excited by the idea of working with David and Bob. And then with David and Bob began negotiating the license out of MIT, because the technology came out of MIT. We put in about just seed capital really to get it going. And the more work that I did on it, the more excited I got. And so we quickly set up the company with our capital. There was no other venture capital involved. It was just Polaris money. And then because of the nature of the relationships that Bob and David had, we quickly got some corporate interest. And so we negotiated deals with 3 pharmaceutical companies to license the technology, which were all in the middle. None of them had reached results yet, but by that time, the platform was well established. And so the company was then acquired by Akamai. That happened all within 18 months. It was just a fairly short period of time. But it was this idea, which is Bob had called to sort of say, there's an idea, there's a researcher that we should work to put together. There's technology at MIT, help us license that in, help us build the team. The team was relatively small when we sold it. It was about 20 people, but it turned out to be the basis of some really interesting products. And so that's, and it was 1,000% return, or whatever the IRR was dramatic. But just a good example of how these partnerships got formed and how we worked well together.
Yeah, for sure. So basically like having a really trusted partners early on, and then the person would probably pick the industry expert for you. And in terms of commercialize it, because of the one scientific like discovery maybe is really helpful in a particular area that the people from the area may already kind of like believe in this subject, and then sort of like go from there. In terms of like co-founding with Bob, like have there been any sort of like challenges that you are facing when commercializing a particular product would be?
Maybe not specific to Bob, but generally, which is if we've done a lot of academic research, and oftentimes we're looking for platform ideas, so it's not a single application.
Right.
And it's funny enough, oftentimes the most challenging part of that investing is identifying the first significant application, the killer app. And so I think that's often been the challenge. In the case of air, there were a bunch of respiratory diseases you could target. There were other diseases that were systemic diseases that could be targeted through the lungs. And so figuring out which is the first way you want to go, you can often, again, it sounds like it's a good problem to have, which you have multiple ways to go, but it can be challenging. And just trying to figure out that killer app is probably the hardest part. And then getting traction. And then once you've identified the killer app, the challenge is then you become known as a single idea around the killer app, and you want to maintain this platform concept. And so how do you focus on one thing without becoming known as only that thing? So it's sort of how do you tell the story around the technology is an important challenge.
I've seen a lot of the innovations coming out of like the mental health space nowadays. Well, at least in Silicon Valley, I've seen a lot of the startup. Seems like, a Headspace or something along that line, focusing on mental health. Curious about like as a healthcare investing expert, where do you see as like the next generation of healthcare app coming from?
There's a bunch of different opportunities. One is, I think, generally mental health is an opportunity space. And so I think people have been working on it, whether it be through the service dimension or whether it be through actually developing drugs. The whole neurodegeneration area is an important space. And so there's 10 years ago, people were avoiding investing in the neuro space. Today, there's a lot of capital that's going after it because it's a big opportunity. I think some of these platform technologies, including the gene editing technologies like CRISPR-Cas9, are going to lead to a series of interesting opportunities. I think the transformation of healthcare delivery itself is going to be an opportunity. We have a company called Iora, which is focusing on primary care and how you change that model to make it more appropriate. And I think that's going to be a successful company, but also it's going to be a successful area. So the simple fact of the matter is healthcare is not a solved problem. There's new problems every day. The more we solve, the more we discover that there's other things that we need to do. And so it'll be a never-ending both challenge and opportunity to sort of serve the healthcare space. And so the one thing that I'm always concerned about is that this one thing gets too much capital. So for example, the whole immune oncology space has gotten a lot of capital. There's been a real flight for immune oncology. It's important. Cancer is a very important disease and its various manifestations to treat, but there's almost too much a single focused effort by the venture community on immune oncology. And so it's coming at it with a diverse approach, I think, is the best way to do it, which is what we've been doing.
Yeah, for sure. So when it comes to like develop your own thesis within the healthcare space, what would be like a general guideline of you would invest in? So is this like going to be like, your primary focus would be just like focusing on the platforms, or is that a particular drug, or is that more like a healthcare devices? When you first started, how do you discover what would be like a strategy for you to invest in this really big space?
You know, when I first started, again, it was a long time ago, there weren't that many deals in the healthcare space. And so we looked at everything. And through the years, we learned that what we were reasonably good at and what we weren't so good at. And so it's like everything else in life. When you're good at something, you continue to pursue it, you get better.
Yeah.
When you're not very good at something, you stop doing it and you get worse. And so if you look at our strategy now, there's a lot of biotechnology in our strategy. We've done well in biotechnology. There are big markets. There are big needs. There's revolutionizing technology that's coming along. There's great entrepreneurs that we can back. There's great academics, researchers. And so it's a very full opportunity set. As a firm, we've backed a little bit away from devices, at least at the early stage. As for us, we found that to be a hard place to make money. I think we've invested in some great device companies, but we've only invested in them later when they've already probably gotten approval from the product or near approval. Although I tell the story, when I joined the business, you have to be careful of dogma. When I joined the business, there's sort of 3 rules, which is don't invest in central nervous system, sort of neuro, don't invest in diagnostics, and don't invest in cancer. And the darlings have been cancer and neuro, they've become the darlings. So if you stuck with the dogma, there's stuff that you would never do, and it would have been a big mistake not to do it. So you always have to be aware of putting on too many rules, but I think we've always just tried to go to what we know best. And again, the better you are at something, the more you're likely to see stuff from people in that space. And so we've allowed it to sort of evolve that way.
So in terms of like the general Polaris investment strategy, I've seen like recently you guys invest in a lot of really cool companies like Drizzly, that's like the alcohol delivery company, Naked Poppy, which is cosmetics for women. And there's like a lot of really interesting other company coming out of Polaris portfolio. Can you tell us a little bit more about like what was the general strategy that you were trying to like build towards a fund? How do you make it like succeed in the next generation?
So when we started the firm, we were diversified. I've been talking about life science because I do life sciences, and I've been making a very personal discussion here. But the firm itself had, of the 3 founding partners, 2 of them did technology and consumer, and I did life science. And so as a firm, we've continued to maintain that diversity. And their history has proved there's some great firms, and again, like Benrock and Greylock and others, which have a history of coming from a diversified background. Some have shifted to a focused strategy. Some have just maintained their diversity. We've decided to maintain that diversity. But if you look at our more recent funds, well, we have things like Drizzly and others, and there always tends to be a technology enablement component to it. So it isn't just a pure consumer play, but Drizzly obviously is using e-commerce as a channel for selling alcohol online. So it's sort of, again, trying to maintain this diversity because from an investing perspective, diversity is a good thing. Maintaining an expertise within the partnership, but not going so far afield that when partners come together, they don't understand each other's world. And over the last 25 years, we've been able to do that.
In terms of managing the fund, normally, like, what would be a typical day for you to make sure everything works together, like including the other partners and the junior people in the firm? What was your managing style? Is that going to be like you take on one junior partner and then work with this person particularly like on a daily basis? Or do you just let everybody do their own thing and then sort of like coming back to like sort of evaluate their deals like from a period of time, or how do you manage a fund?
Yeah. Well, let me also talk about the evolution of Polaris, because while I'm a founder and was a managing partner, I'm now a founding partner. And so there's a group of 4 managing partners that are now. And in fact, I've often said my most important deal in a world of deals is Polaris itself, that makes it really successful. And so I'm really proud of my partners that are now managing partner, Amy and Brian, and along with Bryce. I think that my style when I was managing the firm was really I gave people a lot of rope. I let them pursue their passion, but try to interact with them at critical moments and be there to provide advice and sort of look at a lot of the deals. And so there wasn't this sort of abandonment. It wasn't like, go bring a deal back and we'll decide whether it's good or not. It really is trying to work with them on those deals. And oftentimes, again, with this network concept, which is we would introduce them to people that we like to work with. And so when Amir joined us, for example, he came out of Bob's lab. And so that was a very easy relationship to have. And so, but our style has always been to work pretty hands-on with people that are coming into the partnership, whether they be coming from sort of an academic background or a commercial background. Work closely with them, share ideas, and try to become as partnerly as possible as quickly as we can. And I've often said, which is particularly for young partners, if a deal doesn't work out, it's my fault. But if a deal does work out, it's your
credit.
Yeah.
So like basically creating a successful fund, what have you learned over years as like a pattern, how a successful fund make decisions? Are they more like focusing on like promoting a particular partners, or are they supposed to be working as a group? How does a successful venture firm kind of like evolve over years?
I think the best way is to have people work together and to be as much a consensus organization where people, and I've often said that even though I'm a senior partner and a founder, I want everyone to sort of critically look at my companies and give me feedback. And if they don't like it, let me know why they don't like it. I'd rather know before we cut a check by one of my partners doesn't like a deal. So this idea of consensus, let's all work together, let's get to know each other. I think one of the challenges of bigger firms, and ours is now a bigger firm, is that I can't know every single company in the portfolio. It's near impossible to do that to the level that I would like to. And so I think this ability to be a consensus partner becomes more challenging as you get to be bigger and bigger firms. But I think that there's power in numbers, there's power in partnership and in true partnerships. And I think the firms where you have sort of the lone wolves that come in and bring their own deals can work, and it's some styles that work for some firms, but our style is very much, which is bring it together, let's work on it together, let's figure out whether we do it all together, and use your partners as good sounding boards as you make a decision to pursue a deal.
So in terms of like receiving new deals, because of like Polaris is really like well known now, how do you efficiently select the new investment strategies? So basically you pick the right partners, and then like what kind of things do you like not invest in? Where do you draw the line of things that you don't invest in? Because right now I have a lot of noises, a lot of people are investing in everything, and how do you kind of like pick that this is what we're going to do, this is not what we're going to do?
Yeah. I think because we found success in certain models, we go back to those models. And so there's a bias for doing those types of investment, whether it be platform technologies or whether it be enabling technologies. We tend to invest early on in a company's life. I think it's not so much of what we decide not to do. It's really what we decide to do. And there's only so many hours in the day. There's only so many partners. There's only so much capital to put to work. And so I think the reason to shift away from your strategy is because you're not finding good opportunities in your existing strategy. But at the moment, we've found good opportunities in our existing strategy. So we as they say, stick to our knitting and continue to do the same thing. I think in the past, we've seen the industry, though, go through periods where there was a hot topic. For example, telecom was very hot back in the 90s, and then sort of dramatically fell out of favor. And so our clean technology was hot for a while, and then it sort of fell out of favor. And I think what we've done is we've always because we're a diversified fund, we've always maintained the ability to do one or two of those investments within a fund of 20 or 30 companies. To give it a try and see if we can learn that it's a space that we like. And if it's a space that we like, we continue to pursue it. And if it's a space that we don't like, we just pull back from it. So it's a little bit evolutionary as opposed to revolutionary. And probably the biggest risk in the business is using as I said before, using old rules, the dogma in the past, which is relevant to the moment, and sort of saying, I'm never going to do X. Well, never is a long time, and you should always reconsider stuff along the way. It may be the perfect time to be doing a new idea. So leaving enough room in a partnership to wander over and try something new.
Yeah, for sure. The last piece is curious about how do you do your personal development? Who made the hugest impact in your career? It could be a mentor, it could be your business partner, and who would be your dinner party guest? And what's a book that made the most impact on you?
It's like picking children. It's kind of hard to do. I've been blessed with so many wonderful relationships. Not to sound, as you might expect, the most important people in my life are my family. So they've had the biggest impact on me. My wife's had an enormous impact on me. She's been my best partner through the years, and she's enabled me to do things I never imagined I could do before. So that's clear. My family has been important. My mom and dad, as I said, were always very encouraging, and my mom was an entrepreneur, and so I got a sense of entrepreneurship, both the opportunities and the challenges of entrepreneurship early. Being around people like Bob and Tillman and Kari and Phil and Paul and David and the name Omid, and the name goes on. I'd invite any one of them to dinner at any time, and I'm sure we'd have a very meaningful dinner. And then finally, but as importantly, my business partner through my life has been John Flint, and he's been an extraordinary partner. And then having the ability to bring in Amir and Dave and Brian and Bryce and Amy as now managing partners, they're all important too. So it's really hard to sort of say who's the one person. I'd invite them all to dinner, and we'd have a wonderful dinner.
What is the best book that you recommend for younger people to read?
I should have a single book in mind, and I don't. I like reading this. I tend to like reading the business journals and as well as the scientific, whether it be science or nature. I think the ability to sort of comb through some of those publications on a regular basis to look at where the great science is coming from, who's doing it, I think is have an impact. I'm not sure that's right for a 12-year-old, but it's something that the older I got, the more I liked reading it. So it may sound nerdy, but that's the truth.
Science journals.
Yeah,
interesting. In terms of for people who wants to get into healthcare investing, or who wants to eventually found a healthcare or life science business, or who wants to work in the area, what would you recommend them to do now?
Well, I'll go back to where I started, which is about network. Who you get to know, and I would identify my favorite entrepreneur and try to find a way to get to know her or him. And if you can't directly get to know them, try to find a network of people that are around them, because I think they're the real treasures. I think we don't back technologies, we don't back companies, we back people. And so I think getting access to some of the best entrepreneurs is the way that I would go about doing it.
Yeah. Thank you so much. I really appreciate that you're taking the time chatting with us today.
Absolutely, Grace. Well, thank you.
Thanks for tuning into Smart Venture Podcast. If you learned something from the episode, or even just mildly tolerated me, please subscribe and leave a 5-star rating. I promise I will keep bringing you more successful, insightful interviews and insider tips about startups. Remember, sharing is caring. So tell your friends to listen too, or enemies, I won't judge. Until next time, keep venturing smartly.